Hey there, everyone. Dave Keller with Market Misbehavior, President and Chief Strategist of Sierra Alpha Research. And I am so excited to bring to you my latest weekly show here on StockCharts TV. It's been a pleasure to get to know many of you over the years, navigate these markets along with you, and excited to continue on this journey here. You know, as we get to into the toward the end of Q4 and try to make sense of this market that has been in an incredibly resilient and consistent uptrend. What's next, right? How does this end? And I will tell you, as I mentioned many times on my live market recap called ChartLists with Dave Keller, as I mentioned a lot of times has come up in conversations in my podcast interviews recently. In this sort of environment, I think you consider a chart that keeps making higher highs and higher lows. I think you consider that innocent until proven guilty. But what does that mean to be proven guilty? Today I'm going to talk to you about a technique I call the line in the sand technique, which is something I use when a market is going to new highs or when a chart continues to show strength to the point that now it's up to new all-time highs. And so you can't look to the left and see any clear resistance levels. We're sort of in uncharted territory, pun intended. So what do? So I think you turn into a trend follower if you're not naturally one, and you want to, sort of develop some approach, some system to help you stay in the trend as long as it keeps going up. You want to follow that trend as long as possible, but get some clear signals that the trend may be reversing. Today we'll talk about the line in the sand technique for the S&P 500. I have a couple charts that are recently either pulling back or maybe starting to show signs of a pullback. Talk about how to apply the line in the sand technique to those particular charts. Then we'll talk about 3 ways on the StockCharts platform you can actually make life a little bit easier to try to automate this a little bit and have the platform actually do some work for you, telling you when stocks you might be interested in may be experiencing that pullback that you want to be aware of and help you determine and stick to that line in the sand approach. All right, so we're going to start with a chart of the S&P 500 here, and again on my market recap show called Chart This. Every day when we get to the chart review section, we start with this particular chart. And I was taught by one of my mentors, Ralph Acampora, if you know nothing else about the markets, know the daily chart of the S&P 500. And I internalized that. He told me that. And when I was in my formative years as a technical analyst, I realized looking at the chart of the S&P, the first thing every day was really, really valuable. And just thinking about what incremental changes had happened since the last time I looked at it. And so to this day, first 2 charts I look at every morning are a weekly chart of the S&P 500 with my market trend model, and then this exact chart looking at the daily S&P 500. Now let's talk about what the chart of the S&P 500 is actually doing, because I would say a lot of individual stocks look similar, particularly growth stocks, right? So the S&P 500 has had a remarkably strong 2024. I mean, 2024 has been one of the strongest years on record for the major averages, the S&P and the NASDAQ. Now, the reality is, even though the seasonality at times has suggested weakness, the S&P 500 and the NASDAQ have remained quite strong. And certainly off of the early August low, we can see in late August, we attempt to make a new high. We do make a new high in September. We do make an all-time high in October. We make a new high in November. And now, over the last week, we've made a new high now as we get into the second week in December. So every month since August, we've made a new all-time high. And most of the months before then had actually made a new all-time high as well. So the market is undeniably, right, clearly going higher. We can say that the primary trend is going up, and this is important because of what Charles Dow originally sort of, suggested back in the late 1900s or late 19th century, early 20th century. We wrote a series of essays talking about how you define a trend based on the peaks and valleys or the highs and the lows. And his premise, which we still follow to this day, is an uptrend is a pattern of higher highs and higher lows. So we can say that the primary trend in the S&P is bullish still because we keep making higher highs. And when we pull back, and this is important, we keep making higher lows. The idea is, and again, time frame can be part of this too, right? Depending on which highs and lows you use, that depends on what time frame we're using as a reference. But on this 1-year daily chart, that's kind of where I'm at, which is, over the last couple months, certainly off of the August low, we've pretty consistently made new highs when we've had an uptrend, and then we've had a pullback we've had experienced a higher low than the previous low. So most recently, we had the low here in early October, right around 5,700. We'll call it 5,670. We then made a new high here in October around 5,850. We pulled back, made a higher low. We didn't undercut that low, and we tested the 50-day moving average. We gapped higher. Then we made a new all-time high, trading above 6,000 for the first time in history. Then remember, we pulled right back to 5,850. And that was interesting because it's sort of a pivot point, meaning a level that served as resistance, which now serves as support. Now we've made a new high, touching 6,100 for the first time. Today, on Monday the 9th, we had a bit of distribution. So the logical question is, if we get a pullback, kind of what's next? So the general premise of a chart in an uptrend is we assume that that pattern of higher highs and higher lows is going to persist, or we want to make sure we are aware if the most recent low does not hold. So that for me is what we call the line in the sand technique. The way I think of the S&P 500 at this particular moment, I don't have to apply some dramatic technical approach to determine the price is going higher. We kind of already know that, right? By the fact that the trend is up and we're making higher highs and higher lows, and the moving averages are sloping higher, and the momentum is strong. All of that is bullish. So we know we're going higher. We just want some sort of signal or trigger that would tell us perhaps this uptrend is no longer happening. And one of the ways that Charles Dow would confirm that the uptrend is most likely changed is if we fail to make a higher low, which means, for me, the line in the sand, and this is the point of the video, the line in the sand is 5,850. So anything between 6,100 and 5,850, which, to be clear, is about a 250-point range for the S&P, pretty wide. Anything above here is just noise, right? Because it's just backing and filling within this uptrend. The whole point of Charles Dow's, I think, genius of what he talked about by tracking the highs and the lows, it gets you away from the noise of the day-to-day movements, right? Day to day, the market can be up or down. It can be, all sorts of fluctuations. But what's the overall trend? Well, let's forget about the noise and just hit on the peaks and the valleys. So as long as we make a higher low, as long as we hold 5,850, this is still an uptrend. Which also means if we do not hold 5,850, something's most likely very wrong and very different. And most likely, or certainly perhaps, this uptrend is no longer in play. So S&P over 5,850 for now is a consistent uptrend. S&P below 5,850 would mean we are no longer holding that line in the sand. We're no longer holding that most recent swing low. We would also be breaking the 50-day moving average, which held beautifully back here around Halloween. So if we would get below 5,850, that would mean a lower low and failure to hold the 50-day. Those sorts of things for me would say elevated possibility, more likely that we have a much more painful deterioration going into the beginning of next year. So the whole point of the line in the sand technique is to really minimize the natural behavioral tendencies, right? When the stock initially sells off, you're going to feel very panicked. It's kind of like stalling an airplane, if you've ever done that. And my palms just started sweating. I'm not lying to you. When I just said the plane stalls, for me, it was a very difficult experience as a student pilot to get through stalls and not panic while they're happening, because you basically make the conditions so that the plane does not fly very well. You tip the nose up too much, and all of a sudden the plane shoots down very quickly. Now, what you're taught is how to minimize the downside, right? So minimize altitude loss, figure out how to quickly and relatively painlessly recover from that stall. But the initial stall doesn't feel very good. The initial sell-off on this chart won't feel very good. But as long as we hold support, as long as we hold sort of that floor in our flight path, things just aren't getting that bad. We start to fail to hold the floor. We start breaking down altitude in a big way. That's when things can get very concerning, and we, of course, can crash. And that's where the name, that's where the analogy sort of really comes to a painful head. So the whole point of this line in the sand technique: focus on the most recent price action, keep making higher highs and higher lows, figure out where that higher low would no longer be true. S&P 5,850, that's the level for me. Now, back here, the level was 5,700. Back here, the level was like 5,400. And so that line in the sand for me has been pushed higher. And every time we make a higher high and a higher low, I kind of naturally move that line in the sand to the most recent low. And so your stop is kind of moving up along the way. Let's talk about 3 individual stocks and how this line in the sand technique can be quite helpful. Here's a chart of Amazon, and I would say with any of these stocks like Amazon, we're going through, and I would say like Meta is in the same bucket. Certainly things like, Apple kind of in there as well. A lot of these stocks had a high in the summer, a lot of them around July. Many of these pulled back into an August low. This is when the S&P hit its bottom, as we saw in the previous chart. Then we rallied back in September. We didn't finally regain that July high until the first week in November in the case of Amazon. We then broke above that level and pulled back. Similar to the S&P, we can call this a pivot point, which for me is just a general catch-all way of describing a high or peak that becomes a valley, resistance that becomes support that becomes resistance, either way. Call it a pivot point, just a meaningful level on the chart. So this level, which happens to be a big round number of $200 a share, was resistance in July, then served as support in November. And the stock rallied and this week making a new all-time high around 230. Also note that back here in October, we pulled back to an ascending 50-day moving average. Again, very similar to the S&P, which did that over the last 6 weeks, pulled back to the 50-day and then bounced higher. So we see very similar price action, not surprisingly, in a mega cap name like Amazon. Same premise holds. So for me, anytime I have a chart like this where I either have a long position or the chart is bullish enough that I could argue for a long position, I justify a long position, and I don't own Amazon personally in a portfolio, but if I did, right? I mean, decent chart, making new highs, strong uptrend. What would the line in the sand be? So for me, I always look to the left and see which levels are most meaningful. Here, of course, as we've been analyzing the chart, we have the pivot point around $200 a share. That's also a big round number. That's also the swing low from November, and that's also almost exactly where the 50-day moving average rests this week. So for me, 200, a clear line in the sand. That's around 26 points below current levels. You figure that would be a, 10, 12-ish% drop or so. I'm not sure the exact number, but something like that. So pretty decent drop to get down to that level. But as long as we hold 200 on any sort of pullback here in December, right? And the question, the whole point of the line in the sand is, what if something crazy happens? What if tomorrow everything starts rolling over a big way and Amazon starts deteriorating? What's the level that I think, as long as we hold that, things just aren't getting that bad? And so for me, 200, that's the level for Amazon. All right, I'm actually writing that one down because I don't think I have that alert set up. That's a preview of what we're going to talk about in a bit. T-Mobile US. T-Mobile, obviously a big mobile provider, very popular here in the Pacific Northwest. The Mariners play at T-Mobile Park, so it's pretty. The big pink building is right there off of the highway on the way to the airport. So T-Mobile, pretty widely known. The stock has been absolutely en fuego in 2024. Until today, right? We're recording this on Monday, December 9th. The stock got dinged about 6%, quickly undercutting the last month of gains. We're actually right back to the gap that we experienced in early November. But this is why I think the line in the sand technique is so valuable. What the line in the sand approach basically says, what's that level, right? So for me, I would probably immediately look at that most recent swing low, which is around, 232. We did trade below 232 today. However, we did hold an ascending 50-day moving average. So maybe given that and the 50-day, maybe I would say, all right, 220, 225, would be the line in the sand, meaning we would undercut the swing low, undercut the 50-day. On some of the previous charts like the S&P, like Amazon, the 50-day and the swing low were almost identical, so a really obvious line in the sand. For others, maybe you have to think about it a little bit. And again, where you actually put that level, that stop, that sort of, stop loss, for lack of a better word, it's up to you, right? I mean, that's sort of, relative to your own risk appetite and how aggressive or how conservatively you like to trade. For me, I tend to look at the most recent swing low. I tend to look at an ascending 50-day moving average, and based on those techniques, I kind of come up with a level that is important to me. And I would say with this one, for example, with T-Mobile, I think you have to be a little bit careful. And sorry, I'm kind of doing all the work on the far the side of the chart here, but you can see this sort of big reversal pattern here, which is actually called a dark cloud cover candle from mid-late October. We pulled back to around 222. We broke out. then pull back. So there's your pivot point right here around 233. That was broken today. Anytime you have an initial break, right, we close below that level. Let's say that's my line in the sand today. We did break that level today. However, I want to see tomorrow if we get follow through. And that's a concept that John Murphy, my predecessor at StockCharts, traders and famous technical analysts like Larry Williams and Tom DeMark, John Murphy, and others all had that idea of follow through, meaning when you have a level that's important, if we break the level, you want to see confirmation. You want to see that next bar either doing something in the same direction, having a lower close, a low, whatever that is. And different strategists I've known have had different ways of sort of defining that follow through. But my argument would be just closing through the level is usually not enough, because often you'll get whipsawed. The next day will go right back above. So for me, when we hit the line in the sand, that immediately puts it on a watch list, sort of like the danger list, right? The red flag list, which says we've had an initial break. Now I'm looking for the next day, in this example, to see if there's follow through. And that's probably where I would, make a trade or close out a position, or at least lighten up on a position. Not on the initial intraday break of that level, but that would put it on my list. Then I would say, all right, let's keep this on an active list of charts that I'm reviewing very carefully. So for T-Mobile, I could see the argument of making it the pivot point, as we talked about. Maybe the 50-day moving average would be your line in the sand. But again, the idea here is to have a particular level where we would look. The last particular stock example I want to show you is Kroger. Right? Kroger is a grocery store chain, owns a number of different brands. And consumer staple stock. So actually, tends to be more of a defensive area of the market. But grocery stores generally have actually had some remarkable strength here in the last couple months. We can see that KR, indeed, similar to the previous charts we've been talking about, has been making higher highs and higher lows. And again, when a chart is in a different phase, you don't really need a line in the sand, because you might already see it's going down, or you have some other techniques. This is really something that you apply to a chart that has been in a primary uptrend. The reason why I'm sharing this now is I think so many stocks are in primary uptrends right now and maybe initially pulling back a little bit. So it's important to look at. Here in the case of Kroger, we made a new high around 60, and this is using adjusted data for the record, kind of breaking out above that April high. We then pulled back to the breakout level around 57. We made a new high around 61. Now we're pulling back to an ascending 50-day moving average. In this case, I would probably do a similar technique to what we've seen earlier. Probably kind of go around here. I usually draw the initial line. And so here, right, connecting the April high that connects to the September high, really the October high, we gap above there, we pull back right to 57, and then try to. So now we've made a higher high around 67. A break below 57 would get below the 50-day moving average and make a lower low. So for me, that's kind of an obvious line in the sand. Now, one other quick comment with T-Mobile and then with Kroger. I don't know if you look down at the panels below the price, but the RSI here can be helpful as well. When you have a pullback to support, when you're testing that line in the sand, I like to pay attention to the RSI. And as long as the RSI holds 40 on that pullback, high likelihood that we're going to get a recovery and bounce higher. If we break 40 on that sell-off, that can be a much stronger negative momentum, could indicate much more of a period of distribution, and maybe we want to get out of the way. Just high likelihood that we're going to break down a little bit further. So when we get a pullback, I often will immediately glance down to the RSI. And right now, with a lot of the charts we've been looking at, they're pulling back to an RSI around 40, and as long as that holds, it sort of further validates that line in the sand most likely going to hold. But if we break RSI 40, that usually means the downside momentum is a little too strong, not probably seeing buyers come in to the degree that you want to make a nice return back to that primary uptrend. All right, so we've talked about 4 charts: S&P 500, Amazon, T-Mobile, and Kroger. I'm now going to show you 3 tools on the StockCharts platform that I think could be very helpful in helping you make sense of things. Before we do that, by the way, I do want to let you know about a webcast I have coming up next Tuesday. What is that? December 17th. I'm going to be doing a special year-end webcast. It is free to attend, and it's called Trading Reflections, 10 Questions Mindful Investors Ask at Year-End. I actually did this maybe last year or the year before and had some really good responses really good reaction to it, great feedback, and so I want to do this again. At the end of every year, I actually take a step back from day-to-day trading and strategy and all the stuff that I'm doing, and really answer 10 key questions. These help me understand my performance as an investor. These help me focus on things that went well and what I can replicate, what I can do in my own process to try to make those sorts of things happen more often. I also look at painful experiences, right? Trades that did not go well, and really sort of dissect what went wrong, right? What could I have done better? What did I learn from that experience? And I think forcing yourself to take time at year end to learn from some of those painful experiences, some of those trades that did not go well, that's how you can really improve your process year over year, and that's the goal of that. So please check it out. You can go to marketmisbehavior.com/reflections, scan the QR code that you see on your screen. Either way will get you to a sign-up page. Again, it's a free event coming up next Tuesday, December 17th at 1 p.m. Eastern. If you can't make that time live, just make sure you sign up, and I'll get the replay out to you as soon as we're done. All right. Let us talk about 3 ways we can use the StockCharts platform to track those lines in the sand and hopefully stay on the right side of things. Number 1, obvious, the alerts. As we were talking about Amazon, I jotted down, I don't know if I have an alert set for Amazon at 200. So the way that you do that, by the way, is on StockCharts, click on Charts and Tools, and you can go here to Your Alerts or Price Alerts. Either one is going to get you to this screen. And from here, you basically say, I want a price alert. You put the ticker. I've already put Kroger in here. It gives you a little preview chart to and this is actually very helpful, just so you can remember the general levels you might be looking at. On the chart of Kroger, I think $57 was the one, so I want to say crosses below 57. Here I can say Kroger big time breakdown. And then I can select how I want to be notified. I usually check all these off, which means I get an email. My phone lights up with the text. I actually get a banner on the top of the StockCharts platform. This is the way to get alerted. And you say Save Alert, and that'll give you that happy it went well message. And then you can click on Your Alerts and manage those. I would encourage you to use the alerts system on StockCharts often. And for me, I use it all the time. Anytime I see a chart, I see a clear line in the sand. If the price does XYZ, then I will want to take this particular action. That is screaming alert, set an alert. Use the message here for a note to remind you what you do, because the more you use the alerts, an alert will ding and you'll be like, wait, what was that for? Why did I write that down? So make sure that you make it clear that you know what you're doing. So step 1, use the alerts, and that's a great way, once you define a line in the sand, to make an alert. Second thing, you can actually scan for stocks that have these particular pullbacks, right? And while you can, it would be very hard to scan on a particular line in the sand, because that would be very difficult to, track for 500 different stocks, for example. This is a sample screen, just looking for stocks pulling back to their 50-day moving average. And while that might not be perfect, it does give you within a universe, which stocks are pulling back that you may want to, maybe approaching that line in the sand. This top part, by the way, if you know the StockCharts scanning engine, these are all just ways of refining the universe. I'm saying I want U.S. stocks over a $2 billion market cap, et cetera, et cetera. But these are the 3 lines that I used to really set the alert. So number 1, I want the 200-day moving average to be higher than it was 5 days ago. So just saying the 200-day is sloping higher week over week. I want to make sure that the 50-day moving average is above the 200-day, which means it's most likely in a primary uptrend. That's the goal of these 2 fields. And then this is the most important one, which is the kind of busy way of telling the StockCharts scanning engine, I want it within 0.5% of the 50-day moving average. So PCT diff, that's the percent differentiate or percent different argument. Closing basis, 50-day moving average based on closes, that's what that means. Less than 0.5% higher, greater than 0.5% lower, and that's what that means. So if you hit pause or jot that down, that is the way that you can tell StockCharts, I want things trading really close to their 50-day moving average. Now, this is not perfect. This isn't going to give you a bunch of perfect charts that are in uptrends that have pulled back to a 50-day, but it will include all those and maybe some other things that just the way that I designed this chart might have like some weird thing where it went way down and then traded right up to the 50-day, but you always want to run the scan and then look at the results and just see which charts come up that would be helpful. This is something something, by the way, that I love to run on a portfolio. If I have a portfolio or a watch list, you can import the watch list and have that be one of the criteria that you scan on. Only members of this particular chart list. All right, so alerts number 1, scans number 2, number 3, old school chart lists. I actually have done a video on StockCharts TV here in the last couple weeks talking about the different ways to use the chart list capabilities. It is by far one of the most important parts of StockCharts. I would say the backbone of it, because it helps you do all sorts of cool things that you really can't do on other platforms particularly easily. The reason why I'm bringing this up is I regularly go through the S&P 500 or a particular ETF's holdings or something like that using the chart list feature. And I do it on chart list view once I import the stocks. And then I literally just go through one chart at a time. This is something I'll put the Monday Night Football game on, or some of the Kraken game, something that I'm watching and I'm just waiting for something cool to happen. And I just flick through these with the left hand on my laptop, and on my right hand I have a notepad where I'm jotting down tickers. This is something I started doing back in my Fidelity days. A number of my analysts would do this sort of thing. It is a manual process, but you actually can get through a remarkably large number of charts in a short period of time. And if you have a workable, if you're not looking at 1,000 charts, but you're looking at a manageable list of stocks, it can be an easy way of just flipping through and saying, oh yeah, that's a pullback, and just jot down the tickers and then go back and highlight some of those key ones that you want to follow. So those are 3 ways that you can look for stocks sort of getting near that line in the sand. Number 1, once you analyze the chart, make sure you set an alert. That's an alert. And then the StockCharts platform will let you know when those things might be triggered. Number 2, scan for stocks that are pulling back. And those could help you identify some of those charts that may be in that particular phase. Finally, go old school, right? Put a list of charts, a list of tickers, a list of particular ETFs, and just flip through the charts one by one using this chart list view. It's a great way of just realizing how which charts look similar, which charts look different, and which charts are testing that line in the sand. It can be a very quick way of identifying problem areas in a portfolio or potential long ideas of stocks that are holding that line in the sand. What do you think about this approach, this line in the sand approach? It's something I mention often on my shows, and I was realizing doing a video just sort of talking through how I use that and how it sort of informs different parts of my process would be helpful. What do you use to manage potential downside risk and define the downside level as sort of your stop loss? Drop a comment below and let me know what you use. I'm curious if you use something I didn't feature in the video. For Market Misbehavior, I'm Dave Keller, and remember, it's always a good time to own good charts.